One, the average annual return. This is the metric that all the financial advisors try to give you, and they do this to pull the wool over your eyes. It's intentionally misleading. Investment gurus like Dave Ramsey do this all the time. Online blogs, even a lot of YouTubers, in fact, I'd say 99% of them, and most of the investment advisors that you go to use this average annual return to purposely deceive you. This is how the smoke and mirrors game is played. You go to XYZ Financial Advisor and they'll tell you, yeah, you just need to put your money into a 401k, into an IRA, and invest that in good old-fashioned stocks and the S&P 500, and you will get a 10 to 12% average annual return. And this sounds fantastic. And it's really easy math. If in year one the market returns 10%, year two 30%, year three down 10%, year four down 5%, year five up 25%, you just take the 50, which is the combined total of these numbers, you divide it by the number of years, that's 5, and you get 10%. Pretty straightforward. So you take that number and you say, okay, well, if I've got $10,000 in savings here and Dave Ramsey tells me that I'm going to get that 10 to 12% return, I'm going to be conservative and say I'm just going to get 10% return. And if I get that over 20 years, I'm going to have $67,000 in savings. That sounds fantastic. What could go wrong? Step number 2, this is what can go wrong. You've got to understand the difference between CAGR, which is compound annual growth rate, and the metric that all the financial gurus and advisors use to pull the wool over your eyes. That's average rate of return. And this is perpetuated by your friends and the media and everybody. You always hear these sayings. It's not about timing the market, it's about time in the market. Or your friends, I'm sure, have told you countless times, well, yes, I know, you think the economy is going to crash, or you think there's a recession coming, or that I should buy gold. That's all crazy talk, because I'm in it for the long term. And I know the market goes up and down, but if I keep dollar cost averaging over the long term, my money is going to go up by 10 to 12% per year. I'm going to reveal to you right now how this actually works. I think you're going to be shocked. Let's start with $10,000. That's how much money we have to invest. And we think, because our financial advisor tells us, that we're going to get a 10% return. Okay, well, after year one, if I get my 10% return, I'm going to have $11,000. And then I'm going to have $11,000 with a 10% return. That's going to give me $12,100. After year three, at a 10% return, I'm going to have $13,310. But let's take the exact same 10% average return over here. We've got the market going down by 50%, up by 50%, and up by 30%. These numbers give us a 10% average return. Time out, time out. Let me do some real quick math for you just to show you that this is a 10% average return. We start with a down 50, up 50, we're at 0. We add 30 to that, so our total is 30. We divide that by 3 years, and that gives us a 10% average return. After 1 year, your $10,000 goes down to $5,000. After 2 years, your money goes from $5,000 to $7,500 because you had a 50% gain. You have a 30% gain on top of that, which takes you to $9,750. Although you had a 10% average return over these 3 years, you just lost $250. And that doesn't include inflation. Let me just explain this a little further because it's so crucial that you understand how this works. If we have a 50% down year and a 50% up year, our average rate of return is 0. People would say, well, it's a wash. Well, no, it's not. You lost $2,500. That's because the first year you went down by 50. So when we add the 50%, you're adding it to a baseline of 5,000. You're not adding it to a baseline of 10,000. So in order to get back up to 10,000, you need to have a rate of return in this year or multiple years that vastly exceeds the down year that you had to begin with. And it works like this regardless of whether this down year is at the beginning, in the middle, it doesn't matter. It really skews the numbers, especially if you take it over a 20 or 30-year time horizon, because as we know, the stock market takes the stairs up and the elevator down. So the moral of the story is if you really want to know actually how much money you're going to have at the end of a specific time frame, you've got to use CAGR. You may be asking yourself, well, George, but why do these financial gurus do that? Why do they try to scam us like that? The reason is because if they can make the market look prettier than it really is, you're going to take your money and you're going to invest more of it into the stock market, which means they make more fees off of you. Step number 3, a real world example. I know in that last segment, a lot of you may be thinking, yeah, George, the market's not that volatile though. It's not going to go down by 50% and up by 50%. And that's fair enough. So let's look at a compound annual growth rate calculator of the actual S&P 500. All the gurus like to use the time frame between 1923 and 2018 for their returns. Why is that? They're going from a low point to a high point. Well, for the time being, we'll just give them the benefit of the doubt and we'll just say, okay, we'll use these years. Typing that into our compound annual growth rate calculator, you see that the return, the real return, for that time frame is actually around 10%. So we're not too far off there. Got to give them credit where credit's due. But, and this is a big but, now we've got to take out inflation. When you take out inflation, it goes down to 7%. And we've got to take out dividends. And you say, well, George, why do you take out dividends? That's part of it. Well, not really. Let's throw up a chart really quick here, editor, of the average dividend yield of the S&P 500. And you'll see that nowadays, over the last 10 years or so, those dividends have gone down and down and down to where now they're barely even there. Why is that? It goes back to the Federal Reserve because of ZIRP, 0% interest rate policy. Because they're keeping those rates artificially so low for so long, that brings down all rates, including dividend yields. So if we exclude dividends from the equation, now we're down to 3%. But from watching this channel, you know that the current rate of inflation, what they tell us, is bogus. It's completely fabricated. So if we use the real rate of inflation, let's say that's an extra 3%, now our return has gone down to 0. That $10,000 that you started with, invested over 30 years, is going to give you $10,000. Of course, minus the fees. Now, to be fair, let's use a different time frame where the stock market goes from a high to a low. We'll go with 1928 to 1980. The compound annual growth rate there is 9%. Not doing too bad. But we take out inflation, now we're down to 5.6. We take out dividends, and now we're down to 0.8%. We take out the real rate of inflation, we are down to a negative 2.2%. So if you invest that $10,000 over 30 years, at the end of the 30 years, you will have $5,000, of course, minus the fees. And remember, what's that advice that all the financial gurus give you, and probably a lot of your friends? Remember, it's about not timing the market, but time in the market. Well, I'd look at these two scenarios where one, you're losing $5,000 and the other is a break even. And I would say that it's not about time in the market, it's all about timing the market. And remember, that guru is going to tell you that you're going to get a 10% return on your money. So if you actually got a real 10% return on your money, at the end of the 30 years, you would have $174,000. That's a slight delta between $0 and -$5,000. And this is the reason you see so many elderly folks driving an Uber, working at Starbucks, or working at your local Walmart. It's the scam that investors don't know about, but now you do. For more information like this, check out this content right here, and I will see you on the next video.